All right, here are the three things that you need to know right now on this Tuesday. Thing number one, the International Monetary Fund released its World Economic Outlook this morning. The report forecasts a significant slow in global economic growth and its recovery due to Russia's invasion of Ukraine, among other factors. Joining us with more on this release, Yahoo Finance's Brian Cheung. And Brian, this is the second report in 2 days from a large international body that is cutting its forecasts.
Yeah, yesterday's report coming from the World Bank. This makes sense. Both of them are having their spring meetings in Washington, D.C. It's actually still going to be virtual, but they always like to tee up these meetings by just taking a look at the global growth prospects. And obviously the biggest development since the last round of projections from the International Monetary Fund in January was the breakout of war in Ukraine following Russia's invasion. So because of that, the IMF saying that they have lowered their growth projections to 3.6% globally as measured by GDP this year. That's a marked slowdown from the 4.2% that they had projected in their last round of forecasts in January. I mean, you look at the report overall, minuses across the board, country by country, compared to those last round of forecasts about 3 months ago. You take a look at the United States, they say there's going to be a downgrade here as well. They were projecting 4% of growth in the beginning of the year. They now tick that down to 3.7%. And then you look at a number of other countries as well. The euro area projected to slow by 1.1% compared to their January forecast. And then Russia, obviously, getting a massive downgrade. They now project that the economy there to actually contract by 8.5%, obviously because of all the Western sanctions that have been imposed on that country.
You know, I love having you here, Brian. You wear multiple hats. You're very much our Fed guy. Now, how is the Federal Reserve going to come out here and raise rate 8 times when you see growth forecasts like this?
Well,
they're in a brutal spot.
And now you got St. Louis Fed President James Bullard saying, well, it could be 75 basis points at a time. And actually the IMF noting that the hawkish central banks, not just here in the United States, but around the world, is going to definitely be a part of these forecasts as well. They said that the United States, some of that downgrade is because of the war in Ukraine. There are some spillover effects from the metals and oil, other types of energy-related exports that have been cut off because of the Western sanctions. Obviously, Ukraine being the breadbasket of the world, a part of that as well. But really, they said another big contributing factor to the U.S. growth projections being lower than they were was because of a Federal Reserve that's going to be tightening interest rates at a faster pace than they had thought at the beginning of this year. The whiplash at the IMF, the same as every other trader and investor that's been watching the Fed the past few months.
I mean, the irony here to me is they're downgrading forecasts in part because of high inflation and the pinch that is causing, right? Because of Russia, Ukraine, and the inflation spillover effect. The Fed is cutting rates to slow growth to combat inflation. I mean, it's like this weird
feedback loop.
Exactly.
Yeah,
exactly.
I mean, it's its own wage price spiral, if you will, in the opposite direction, right? The idea is that if inflation is going to get higher, which that's going to be impacting other areas as well. I mean, the IMF had pointed to some regions where, the central banks have already been hawkish, but the inflationary pressures that are continuing to run amok are actually weighing down on the ability of those countries to continue to grow. Keep in mind, we're also in a pandemic still, right? They're trying to get past that as well. But when you take a look at these advanced nations where the central banks are really in focus, the euro area with the ECB, the Federal Reserve here in the United States, well, again, that's factoring into all of it. But the story remains the same. If you have high inflation, you're going to have higher interest rates. Both of those things are net negative for economic growth. I mean, yes, inflation does push up the C part of GDP, but at some point, there's an inflection point where people can't afford to spend it anymore. You get the demand destruction, GDP goes down.
Well, I need these rate hikes to start bringing down my gas prices, Brian, because I'm just paying about $6 a gallon.
I'll give Jay a call. I'll see what I can do. Yeah.
Brian Cheung, thanks so much.